Hello, good afternoon. Hello, can you hear me?
Good morning, sir. Yes, we can hear you.
Hello?
Good morning, sir.
Good morning, sir. We can hear you.
Yeah, good morning.
We can hear you, sir.
Yeah, good morning.
Good
Sorry
morning, sir.
for yeah, good morning. Yes, sorry that I had an issue with my laptop since, but it has been fixed now. So we'll commence very in a bit now. Just give me, yes, thank you. So I hope we all have the material with us. We are going to continue with the last material we are using on basis period. Hello? I said I believe we all have the material with us.
Yes, sir.
Yeah, okay. Thank
Yes,
you.
sir.
Yeah, thank you. Sorry. So, please, we started with basis of assessment. For those that just came in, that are just joining us newly, because I can see that we have some new entrants here, looking at the number. So we started the last time with basis of assessment. So where we talk about the basis of assessing a taxpayer to tax. So that is what basis of assessment is all about. Then under that basis, we talk about some information, accounting period, accessible income, accounting year, basis period, and so we also talk about actual year and preceding year basis. So we should mention that. Then we talk about the basis of basis period, types of basis period. Where we said we have the normal basis and abnormal basis. So for the normal basis, we mentioned that it's usually, there is no issue with that because it's usually a period of 12 months. Then there's no overlapping and gap. But in the case of the second, which is the abnormal basis, that is where the issue lies, where you have irregularities, where we may have less than 12 months or more than 12 months, or where one basis period may extend to another basis period. So we are able to stand under that, and I told us that we have three scenarios. We have commencement of business or trade, we have cessation of business, then we have change in accounting dates. So we started with the first one, which is commencement of business. So where I told you that for a company, for a taxpayer commencing operation, whether individual or company, so the rule is that their basis period should be based on preceding year basis, in line with what? In line with the accounting date, accounting period. Then I also told you that it is possible during commencement to have what is called gap in the year of assessment. So there may be gap in the year of assessment. So gap in the sense that when the accounting date comes before the commencement date, in that situation, you will not be able to have an accounting period for the first period. So the first tax year will be what? Will be the second tax year and not the immediate tax year. So that is, so, and we are able to look at some analysis there. So, but we are here to solve a question. So we are starting with, today we'll be starting with the first illustration. I hope everyone is with me.
Yes, sir.
Yes. We are starting with the first illustration on page 6. First illustration on page 6. So the question reads thus: Nengi Nigeria Limited was incorporated on 1st of August 2019, but due to logistic issue, the company did not commence operation until 1st of April 2020. The company
Excuse
accounting
me,
year
sir.
end is, yeah? Okay.
Sorry, are you taking
Have
us
we
through what
treated
you
that?
have? Yes, we have passed all those time. We have done
Okay,
cessation
we are
of
fine. Okay.
business.
Okay, where did we stop?
We stopped at this golden touch, cessation of business. I think that is on
Okay,
page 12.
page 12. Okay, let me see. For me, I want to. Golden touch. Okay.
Hello, sir. Do you mind sharing
Okay.
your screen?
What did you say?
Sir, please, can you do a brief summary for the new people here?
That
Can you
is what
share
I
your screen?
wanted to. Okay.
Yeah, please
Okay,
do it,
okay.
please.
I will. Okay. Okay, let me do a bit summary for those that just join us. So please let us kindly endure with them. So for those that are just joining newly,
Yes, also, please, can you share your screen?
yeah, I'm coming. I'll do that now. The material has been successfully shared. I hope we all have it now. It has been shared. Please, can somebody confirm to me that we have the material?
We have the material.
Yeah. Yes. Thank you. So,
So please, I think what she's saying is if you can share your screen.
What did you say?
I said, I think what she's saying is if you can
Hello?
share your screen. Can you hear me? Hello, can you hear me?
I can hear you.
Okay, I'm guessing what she's saying is
What she's saying is what?
if you can share your screen.
I should share the screen. I have done that. Have you not seen it? I've done that. Let me
We are
try.
not.
Let
We
me
are
do
not
it
seeing
again.
it. We are not seeing it.
I've done that already. Okay.
Oh, we are not seeing your screen. I mean your
Okay,
screen.
let me do that again.
Okay.
Yeah, I'm coming. Let me do that again. I'm trying to. Please, can we do something? I think it's network problem because I'm trying to share. It's not going. Can we go to the WhatsApp? The material is on the WhatsApp group. Okay. Yeah. Success. So I think it has been shared now. So can we also get the material now? Hello, please. Can somebody respond to me, please?
Yes,
Hello,
the
No,
sir.
material is on WhatsApp group, but they are saying that you should share your screen so that we can see what you are looking at from here.
Yeah, I've done that. I've done that as well, but I think it's network because I've done that twice. Yeah, so that's why I'm saying maybe because of the timing, because I've done that twice. Let me do it again. I don't know why all this network. Let me do that again. Because it's telling me that it's already there, sir. Okay. Let us check. I think it's there. It's on the screen is there now.
No, sir.
It's not. It's network. Oh. Please let us go. Let us go to the WhatsApp group and get the material there, please.
I'm thinking maybe you should just go off and come on again. Maybe to now do.
Okay, maybe it will come up. Okay, yeah. Let me do that. Okay. Thank you. All this, yeah. So this taxpayer, so if you look at the material on page 1 of the material, we have some definition of terms, so which we are able to look at the other time. So, but the major one are we have accessible profit or income. So when they say accessible profit, that's the totality of all the income that's generated by a taxpayer for a particular period of time. So all the income added together is what is regarded as accessible profit. Then another important one is we have what's called the tax year or year of assessment. That is usually the government tax year, which is usually the tax year that is specified by the government. And it's a period of 12 months, which is from January to December, which is the government tax year, period of 12 months, January to December annually. So as a taxpayer, it is not compulsory to follow the government tax year. You can decide that you want to what? You want to use your own separate tax year. It is allowed. You can use your own separate tax year. So in which one? So you adopt your own separate tax year that is different from that of the government or the government tax year. And then we also talk about the accounting year. So that's the year that the company decides to adopt as their own year of preparing their accounts. Then under basis period, I said we have forms of basis period. We have the preceding year and actual year basis period. So the actual year is as the name implies, actual. The period that we start from the same year and end on the same year is the actual period. Start from the same year and ended the same year. While for preceding year basis, preceding year, that is the period that is before the tax year. Period before the tax, the basis period is going to end in the year before the tax year. So those are what we talk. Then under that we have category of basis period. We have two categories. We have the normal basis period and abnormal basis period. Normal basis period and abnormal basis period. For the normal, which I explained earlier, that is the basis period that is normal, as the name implies. It is usually a period of 12 months. It will be for a period of 12 months. Then it is a period that there will be no gap or overlapping in the basis period. Then it is also a period that immediately one begins, the other one is also commencing. That is the normal basis period. Then in the case of the second one, we have the abnormal basis period. Abnormal basis period, which is the basis period that does not follow the characteristics of a normal basis period. It does not follow the procedure of a normal basis period. So that is basis period that may not be up to 12 months. It may not be up to 12 months. There may be overlapping in the basis period. As one is ending, another one will follow that period. So under the abnormal basis period, we have three scenarios. We have the commencement of business or trade. We have cessation of business of trade, and we have a change in accounting.
Hello, sir. Please, what page are you, sir? What page are you now?
Okay. So I'm just doing a recap of what we did. So, okay, but the page, I'm on page 3. Page 3.
Okay, sir.
Page 3. So you see situation where abnormal basis period is present. Situation where abnormal basis period is present. So there are series situations which are commencement of business or trade, cessation of business, and change in accounting date. Those are the three situations that we may have those periods. So in the first one, under page 3 as well. So we have what? Commencement of business or trade. In the first scenario, for the commencement of business or trade, so under page 3 as well. So the rule is that, simply put, the rule is that the basis period we are going to use must be on preceding year basis. It must be on preceding year basis. It must be preceding to the tax year. If you check page 3 as well, under that information, you have towards the end of page 3, we have first year of assessment. This is a basis of assessment for new business. We now have first year of assessment. So in the first year of assessment, the basis period that there will be assessed to tax will be from the date of commencement of business. From the date of commencement up to the first accounting period. Up to the end of its first accounting period. From the date they commence business up to the end of their first accounting period. So if you look at that, in page 4, there's an illustration there that says, assume Aduni Limited commence business on 1st July 2020 and make up its account to 30th September annually. The first accounting year is 2021. So which is, because the question says, so the first to be assessed as, so the accounting date is September, why they commence on 1st of July. So the basis period, if you look at the solution, the basis period will be from the date of commencement, which is 1/07/2020, to their first accounting period. And what is the accounting period? 30th September. It will not, because in that 2020, after July, we can get September, that's September. It will now be 30/09/2020, which is for, so the year of assessment will now be what? Year afterward, the year of commencement, which is what? 2021. Will be the year of, after the year of commencement, which is what? 2021. Then the same thing is applicable. Then I said that there may be a gap. There may be a situation whereby there is going to be a gap in the year of assessment. Instead of having the next year to be the tax year, the tax year may be what? Extended further, more than the first year. That is when what? When the accounting date comes before the what? The commencement date. In that situation, there is going to be a gap in the what? In the year of assessment. So if you check a good illustration of that is illustration 3. Illustration 3 under page 4. Illustration 3 under page 4. So we have it at Ojabelu Venture commenced business on 1st April 2019 and makes up account to 31st March. The first accounting, so under this situation now, you see they commenced business in 2019 and the accounting year end is 31st March. On a normal day, the first tax year is supposed to be 2020. But because accounting date, which is March, comes before April, by the time we are calculating the basis period, you will not be able to have a period end for that 2020. As a result of that, there is going to be what? A gap in the year of assessment. So the year of assessment, instead of the first year of assessment will now be 2020, it will now be 2021, in which the basis period will now be from the date of commencement to their first accounting period, which is from the date of commencement 01/04/2019 to 31 to accounting date, which is 31st of March 31/03/2020. So that is the procedure of what? Of doing what? Commencement of trade, which is what? The commencement of trade. Then after commencement of trade, We also have again, we mentioned about cessation of trade. Cessation of trade, which we started the last time, which is, so that is every company is expected to be on a going concern basis. But due to certain scenario, certain circumstances that may be beyond the company capacity, they may decide to stop operation. Where they decide to stop operation, the tax law will also be applicable, because it has been stated earlier during commencement that accounting basis period should be on preceding year. That means the company will have been adopting preceding year from onset. So when they now decide, to now change when they now decide to cease operation, so what will now happen? So the tax law is that for any company that decide to cease operation, the basis period will be from their last accounting date up to the date of cessation. From their last accounting date up to the date of cessation. That is on page 9. Page 9. Their last accounting date, if you see basis of assessment, it will be from their last accounting date up to the date of cessation. Then the law now distinguishes the taxpayer into two forms. When you are ceasing up a business, it is either you are an individual taxpayer or you are a company. For individual, they have within 3 months after the date of cessation to pay any tax liability arising from that cessation. The while for company, the company has within 6 months to also pay what? Any tax liability arising from the cessation of business. So that this period will assist us in knowing the applicable tax year that we are going to adopt for computation of the tax liability. So under that scenario, so you have to be vigilant to look. And how do you know whether the taxpayer is a company or an individual? Who can assist us? The taxpayer is a company or an individual? How do we know that a taxpayer is a company or an individual? Anybody to help? Hello? Hello? Are we there?
Yes, sir.
Yeah, I said, how do we know if a taxpayer is a company or an individual? Anybody to assist? To give us an hint to know whether if a company if a taxpayer is an individual or based on the information provided to us. So the only way to know whether if that a taxpayer is a company, so you have to look at the name given to you. Where the taxpayer is a company, you will find the word limited or PSC after that name. And where the taxpayer is an individual, you either see name of somebody, or you see ventures, or you see enterprise. That won't be limited in the name of what? The name of that taxpayer. For instance, like the example we have in the question, illustration 3, under page 10, we have Bakoje Venture. You can see that has told you that that particular taxpayer is an individual. Is an individual. Why? Because what that name is what? Is the name of what? Of an enterprise. So it's an individual taxpayer. It's not a company. If you see, whenever you see limited or PSC, that tells you it is a company. So I believe, so if we go over the material again, so we should be able to. Then we also mention about terminal profit. That there may be situation whereby after cessation of business, the company is able to make certain profits. They are able to either receive certain payments after they have ceased operation. Maybe those people that are owing them now decide to pay or a payment that they are owing. The company now have money to what? To make payment for that money, which is done afterwards, cessation of business. When such situation occur, that is under page 11. When such situation occur, that transaction will be deemed as if it occurred on the last day of cessation. So the essence of that is that we are going to adjust it on what? On the last profit, as at what? The last day of cessation. It will be adjusted on the profit as at the last day of cessation. So adjusting it on the profits, we are going to arrive at what is called what? Terminal results. So that will give us the terminal result, which may be the terminal profit or loss, as the name implies. Then how do we do this adjustment? Where the necessary adjustment, where it is a payment, it will be deducted from the last accessible profit, and where it is an income that is being additional income that is being received, it will be added up to what? To the adjusted profit. So that is where then I believe. So we have illustration Golden Tech. So my question now is, have we solved the question on Golden Tech?
Yes, sir.
You have solved it? Okay. So that means, okay, if we have solved the question on Golden Tech, so please, I will implore the other students also to get information about that from the previous note, from the previous recording. So the next one, today we'll be starting freshly with change of accounting dates. Change of accounting dates. Change of accounting dates. Change of accounting dates. So under this scenario, change of accounting dates, I mentioned earlier when I was explaining that. So this is under page 13. Please let us go to page 13. Page 13. From the material, page 33. From the material. Are we all there? Please, can somebody
sir.
respond to me? Are we
Yes,
on page
sir.
13? Yes. Okay.
Yeah,
So
yes,
if you
sir.
check, yeah, on page 13, we have change of accounting date. So that is where we are starting from freshly today, change of accounting date. So what do we mean by this change of accounting date? Change of accounting date. Change of accounting date. I want to see if I will be able to share the screen again now. I'm trying to, share to, I don't know why. Okay, but it's telling me success here. I don't know why it's not showing. So change of accounting date. I don't know why it's not showing on the Zoom. So change of accounting date.
Is
So,
it full screen?
yeah.
Are you sharing the full screen?
Yes. I'm sharing the entire screen. I don't know why it's not showing. And it's telling me success here. But let us continue. Just get the material from the group, please. So we have what? Definition of accounting, change of accounting date. So we have what? Accounting date. As stated earlier, accounting date, that is the day that a company decides to what? To prepare their record. By matching what? Their expenditure with income to know whether they generate a profit or a loss. So a company may decide that they want to change the accounting date due to certain scenarios. There may be reasons why a company may say, okay, they want to change what the accounting date. So where this occurs, the tax law does not just look at the company with levity. There are applicable law available under section 29 of CETA, of PITA, and section 23 of CETA. So section 29 of CETA and section 23 of PITA. So there are applicable law guiding what that change of what accounting date. So what are those laws? So what before we go to the law, on page 14, we have reasons that may make company to what? To change their accounting date. What are the reasons? One of them is what? To obey government legislation or directive. I said earlier that what government tax year is a period of January to December. As a company, you may decide that, okay, you want to go in line with the government tax year. So as a result of maybe you have been adopting different accounting, so you now want to go in line with government tax year, you may decide to want to change based on that. Also, it may be as a result of a new tax policy. Maybe a new tax policy is being implemented that require company to also what? Effect some changes. May also lead to what? To changes of accounting dates. There may also be for companies that are a group of companies, parent and what? And their subsidiary, holding and subsidiary. So the subsidiary may also want to go in line with the accounting date of what? Of their holding company, so that to help in what? In consolidation process. So that consolidation will be easier for such company when they want to what? Consolidate their activity together. Also, another reason is when there is what? Merger of acquisition. When, for instance, merger is when two or more companies come together to become one. Maybe, for instance, Coca-Cola now, they are the largest distributor of soft drink, Coke and Pepsi, and so they are the largest. So maybe Biggie and American Cola, they now find out that they want to enter the market. They want to enter the market of Coca-Cola. Biggie and American Cola may decide to join together, to come together to become one. So when they come together, that coming together is what is regarded as what? Merger. So, before coming together, there are two different companies. They now want to become one. Those two different companies may have different accounting dates. So when they now become one, they have to streamline their accounting dates into one. So that is why the situation whereby you may also have change of accounting dates. Then for you to change your accounting date, it is not automatic. So we have tax authority consideration after the reason for change of accounting date, also in page 14. So what is the consideration? What are those things that tax authority will consider when a company want to change the account? One of them is that you must write. It's not that, okay, you just wake up one day and say, yes, we have decided to change our accounting dates. No. There must be a written application that will be made to the tax authority. So, for instance, if it is federal inland, if it's a company, so because the company income tax is payable to Federal Inland Revenue Service, there must be written application that will be made to Federal Inland Revenue Service to request that they want to change their accounting day. So, and the reason for that change must also be stated in that their request. Another thing that tax authority will consider is if you want to change your accounting date as a result of you to evade tax. Under tax system, we have what is called tax avoidance and tax evasion. We have tax avoidance and tax evasion. Tax avoidance is when you are looking at the loopholes in the tax law in order to reduce your tax liability. Then while tax evasion is when you are avoiding payment of tax entirely, or you are doing wrong activity, you decide not to declare your income. So another thing that the tax authority will consider is where the reason why you want to also change your accounting date is to evade tax. That is, you want to make sure that you don't want to pay tax, or you don't want to pay the appropriate tax. Such changes will not be considered by the tax authority. Then if you are requesting to change your date, you must give guarantee that that new date you want to change to is going to be what? Permanent for a long time. It's not something that you change a date, maybe last year now. You now come again this year and say, please, so there is an issue again. We also need to change our date again. So there must be what? A guarantee, a confirmation that what that particular date, new date you want to adopt will be what you are going to adopt to perpetuate. It must not be something that what you are still going to come back and say, okay, you want another change of date. So those are the what the tax authority will look at for what? For change of accounting date. And under change of accounting date, as I said, what are the requirements of the tax law? What the tax law will look at is very simple. The tax law will look at, so the procedure to be adopted for change of accounting days, page 14 as well. So the first procedure is that what? You determine the first tax year when the change occur. Determine the first tax year. That is, when is the first year that that company decide to change their accounting date. The first tax year that change occur, you must first of all determine that first tax year. After the determination of that first tax year, so you now determining two subsequent years. You determine two subsequent years that follow those years. Determination of two subsequent years. So you determine the 2 years immediately following the year of change. So what are we saying there? So what do they mean by that? For instance, assuming a company changed their accounting date in the year 2021, that is the year of change. So after 2021, the year following 2021 will be 2022 and 2023. So so for computation purpose, you must determine those 3 years for the purpose of taxation. So that means you are going to determine the first year of change, which is 2020, and 2 subsequent years, which is 2021 and 2022. Those are the 2 subsequent years that will also be determined. So after determination of those 2 subsequent years, so that means now we have how many years in total? Who can tell us? How many years do we have in total?
3 years.
How many years do we? 3 years. So that will give you 3 years. So we have 3 years in total. So after determination, so when you now have those 3 years, the next thing to do is to now compute accessible profit. You compute accessible profit. Compute accessible profit for the above 3 years. For those above 3 years that you have. Using what? Using existing old accounting date on preceding year basis. You are going to compute accessible profit using what? Using old accounting date. So what do they mean by using this old accounting date? For instance, assuming a company has been preparing their accounts using 31st December as their accounting date. So you are going to compute accessible profit for those 3 years, 2020, 2021, and 2022, for those 3 years. Using what? Using old accounting date. So using old accounting date. Thank you. I think my laptop is now.
Hello, sir.
Hello? I can hear you.
Yeah. Okay. I want to ask, is there new accounting date?
Yeah. I'm going there. I'm coming. I'm coming. I'm going there.
Okay.
Yeah, there is a new account. So I have switched my Okay, don't worry. I think this one is still giving me issue. Yes. So you prepare using what? Old accounting dates for those 3 years. Then because what we are doing is a change of accounting dates. So that means the company may decide that they want to change to March. Then that March will now be new accounting date. You also compute the next step is you also compute accessible profit for those period. You will also compute accessible profit for those period using new accounting dates on what? On a preceding year basis. Using new accounting dates on a preceding year basis. That is, old accounting dates is December. You compute accessible profit on preceding year basis for 2020, 2021, and 2022. You also compute the same thing. New accounting date is March for 2020, 2021, and 2022. Using what? March as the what? New accounting date. So you compute them separately. So after computing them separately for those 3 years separately, the next thing is that when you add those transactions up separately. Add up separately your results. You add the result for the old accounting date and also the result for the new accounting date separately. Add those results separately. After adding it up, you now compare the two. During your comparison, you want to look for the higher one. Higher one will be selected. Why? Because under change of accounting date, the tax authority is the one that is giving the right of election to what? To select. And for tax authority, they want to maximize revenue. They want to get more revenue. And they are giving, the tax law has given them what? The right of election. So as a result of that, the highest figure between the old accounting date and the new accounting date will be selected as the figure that will be what? That will be utilized for what? For the information. So after you have selected, so the next thing is that all what you are doing before are workings. The next thing is that you now need to what? To write out the summary of what? Of the one you select as your what? Final solution. If it happens that it is the old one that is higher, the old one will be selected. If it is the new one that is higher, the new one will be selected as the what? As the final answer. So don't forget, you may be asked in the exam, that's what? The right of election lies with who? It is the tax authority under what? That is only available under change of accounting date. Under cessation and commencement, right of election has been abolished. Why? Because there is no more overlapping of basis period and there is no more what? Gap in basis period. So no more right of election anymore. It has been abolished by the Finance Act. But under change of accounting date, there is still right of election to be exercised by the tax authority, in which they are going to select the higher between what? The old accounting date and the new accounting date. So I hope this step is clear to us. Any question?
Okay, sir. My question is that when you said they would prepare the accounts for the 3 years using the old and new, so basically they will be using the same information, right?
Yes. Yes,
But
the
what I
same
want to get
information.
right, now is that if they are using the same information, how is it possible that they will get different results?
Yes, fine, good question. They are going to use the same information, but different results in the sense that the basis period are not the same. Like the example I gave, one basis period is from January to December. By the time you prorate, the amount you have will be different from the one that is from April to March. Is it clear to you now?
Yes, sir.
Yeah, so that is why you will not get, you can never get the same because the basis period are not going to be the same. And because the basis period is going to enter one another, so as a result of that, one basis period from a particular year may come into another year. So when that one comes, it's going to have effects on the other basis period, which will make them not to be the same. So any other question?
Okay.
Any other question?
Like the figures will be different. Like the figure.
Yeah, the figures are going to be different. You cannot have the same figure. We will have different figures.
Different, right?
Yes.
Talking about the figures will be. Okay.
Yeah, the figures will be different. But I told you, for the 3 years, you are going to add up the 3 figures together. Add up the one for the old, add up the one for the new. By the time you add them up, when you add them, the figure, you are not going to get the same figure. The figure will be a different figure entirely. Any other question?
Okay, sir.
I'm not getting this thing. The fact that
Okay, I'm with you. Hello?
I'm struggling to even follow through because I'm looking at it from my system, looking at what we are calculating. I'm not getting it.
No, relax. What I'm doing is I've not started with the calculation. I just use that information. Are you on page 14?
Yes, I'm on page 14.
Yeah. Page 14, before the last word, determination of final tax year. Procedure for assessment where there is approval. Are you there?
Yes.
Procedure for assessment where there is approval. Hello? Are you there?
Yes, I am.
If you look at that procedure, that is the step to follow when there is change of accounting date. How do you know that there is going to be a change of accounting date? Let me just use this one that is under. Let us go to page 15. I will still come back to that 14. But let us go to page 15. Page 15. Look at that situation A. The first word on page 15. You have year ended 30/06/2020. We have another one, year ended 30/06/2021. We have period to 31/12/2021. We also have year ended 31/12/2022. Year ended 31/12/2023. You can see that this company has been adopting what? June. They adopt June for 2020. Adopt June in 2021. When you now get to the end of 2021, they now change to what? December. That is what they mean by what? Change of accounting date. They change from June to December. Do you get that now?
Yes, please.
Yeah. So after going through that, so once you now know that, okay, once you have established that there is a change, the next thing for you is that you now go to what is the procedure to be adopted? The first thing is that you determine the first tax year that change is going to occur. Let us use that illustration on page 15 to do this question now. Determine the first tax year that the change is going to occur. We have this information, year ended 30/06/2020, year ended 30/06/2021, period to 31/12/2021, year ended 31/12/2022, year ended 31/12/2023. Please, who can tell me which year do you think this company changed their accounting date?
2021.
Yeah, 20 what?
2021.
Which year? 2021. Yes. Look at it. You may say it's 2021, but that is not the year of change. The year of change is what? 2022. Why? Because don't forget what we learned earlier when I told you period to and year ended. I told you when you have period to, that is what it is. Either that information is what? Either lower than 12 months or more than 12 months. Abi?
Yes, sir.
Then when you have year ended, that is what? the period is what? A 12-month period. Because in 2021, the company has already prepared their accounts. They have a year ended in 2021 already, which is what? Year ended 30/06/2021. They have already prepared their account. They have already have a year end. So you cannot have 2 year end in the same year. So that means that 2021 will not be the year of change. The year of change will not be what? The following year, which is what? 2022. Because the reason is that they have already prepared account for 2021. They cannot. My question now is, can a company prepare 2 accounts the same period for 2021?
No, sir.
It's not possible. Yes. So the next account they are going to prepare now will not fall in the next year. So that means the year of change will be what? 2022. So you identify that first year, which is what? 2022. That is the first year of change. First year of change, 2022.
In this case now, are we not, sir? Sorry, sir. In this case now, are we not taking up that period too? So are we going to leave it? That's 2021.
We are going to use that. Yes, thank you. The fact that what we are looking at, what we are identifying is what? Tax year, not the basis period. Do you get it? We are still going to use that period when we are doing the basis period. But what we are identifying now is the tax year. There has already been a tax year for 2021, which they have prepared. So that means the next year will be what? 2022, which is what? The next year they change will be what? 2022. Do you get that now?
Okay.
Then the solution,
yes,
the question, the procedure now says, after you have identified the first tax year, identify 2 subsequent years following the first tax year. In this scenario now, we identify year 2022 as the first tax year. Abi?
Yes,
you can see on the last sentence there, they now said, therefore, the 3 statutory years are what? 2022, 2023, and what? 2024. Yeah, those are the 3 statutory years. You first of all identify the first one. You now identify 2 years that will follow that first one, which will be 2023 and 2024 in this scenario. So is that clear? Do we get that? So after we identify that, that means we have what? 3 years. Abi? And
yes,
every 3 years, we have 2 accounting periods. According to this information, we have one in what? As at June. And we have one we have one as at when? December. Is that right? Yeah. We have one as at June and one as at December. So the implication of that is that June is the what? Old accounting date.
Hello, sir.
Why the December own? Hello, I'm with you.
Yeah, sorry, I just want to get this clear now. Like you explained earlier that this period too is either less than or more than. And then you also mentioned that we have to prepare account for the old accounting period. So basically, since we have June of 2020, June of 2021, so the last year of the previous accounting period is inside this period too, right?
Yes,
then
thank you.
The first year of the new accounting period is also inside that period too.
Yes, thank you.
All right, sir. Thank you, sir.
So, in that situation now, so what if we are not going to prepare accounting? So, under this situation now, the old accounting day will be June. That is the old one. Then the new accounting date will now be which month?
December.
New accounting day will December. Yes. So that means you have what? 2 accounting periods, June and December. So the rule is that for those 2 accounting periods, you are going to prepare assessable profit for those 3 years. You will prepare assessable profit for 2022, 2023, and 2024 for those 3 years. Assessable profit for 2022, 2023, and 2024. You use what? About the accounting date. You use June for those 3 years separately. You also prepare another one separately using what? December. You prepare using old accounting date. You also prepare using new accounting dates. Do we get that now? So after that, the next step is that you now add up those your information separately. You add the one for old accounting date, the 3 years separately. You add the one for the new accounting date, the 3 years separately. Because it is the tax authority that has right of election. They did not ask you to what? To go and change your accounting date. You are the one that said you want to change. So as a result of that, they are going to select the one that will give them the higher tax liability. And how will they get that? That means the one with the higher accessible profit will give what? The higher tax rate. So that one will be selected from what? From the choose scenario. So I think that should explain it better now.
Hello, sir.
Abi? Hello?
Hello, sir.
I'm with you. Yeah.
Okay. You said we are going to add the first 3 years of the new accounting date, the old accounting date.
Yeah.
And the will pick the higher one.
The higher one, yes.
My question now is, are you saying that for the first 3 years, the company will not pay tax?
Okay. The reason why you are adding them, I said you are going to select the higher one. The reason why you are adding them up is that you want to know the one that will give them higher tax liability out of those 2 dates. They are going to pay tax on the one that will give what? Higher tax liability. Because tax authority are to maximize revenue. So the one that will give higher tax liability will be the one with the higher accessible profit after addition. Is that clear? Does that answer your question? Hello?
Yes, sir. Not entirely, sir.
Yes. Look at it. Let me break it down. Looking at it, you have 2 periods for 2022, 23, and 2024. Those 2 periods now, one of them will give you higher tax. They are going to pay tax in those 2 periods. But because they change accounting dates in those periods, they are going to be made to suffer to pay higher tax for those periods. So that is the reason why you select the one with what? Higher accessible profits. I hope it's clear now.
Yes, sir. Thank you, sir.
Yeah, you're welcome. So then, looking at the next one, we have a situation B. We also have another situation there. On page 15 as well, you have year ended 30/09/2000, year ended 30/09/2001, year period to 31/12/2002, year ended 31/12/2003, year ended 31/12/2004. You can see that this information is different from the first one we did. Under this one now, who can tell me what is the old accounting date?
September.
And what is the new accounting date?
December.
Yes. So in this situation, we have September and December. If you look at this one critically, it's different from the first one. Which year does the company now change the accounting date here?
2023, 2003.
Are you sure? Look at it very well. No? It cannot be 2003. 2000 and what?
2002.
2002. Why? Because if you look at the year end we have before that period too, the year end we have is for which year? Year end we have before that period to 31 to is for what? 2001. That means for 2002. Yeah, that means for 2002, the company is yet to prepare any accounts.
Oh.
I hope we got the difference now and the logic behind it. Under this one, for 2002, the company is yet to prepare any account because we are not giving any year ended. So because they are yet to prepare any account, that means that year, if they want to prepare any account, because they have changed in that 2002, that year will not be what? The year of change. It's entirely different from the first one. If you look at the first one up, you will see that one, in 2001, they have year end, they have prepared accounts. You cannot have 2 accounts in the same year. That's why you go to the next. But this one, in this situation 2, period 2, they are yet to prepare any account for 2002.
Yeah.
So that means the year of change will now be what? 2002. You not identify what 2 subsequent years, which will be 2003 and what 2004. I hope we got the difference now.
Yes, sir. But for that,
please,
for that previous
okay.
account, yeah, that means it's not up. It not be up to 3 years now.
It will now. What you are after is you are less concerned about the information they give you, even though they don't give you info. What you need is what those 3 at 3 years. Information we have here is different from information we have in the upper one. This one we have known is 2002. Just identify 2 subsequent years, which is what 2003 and 2004.
Yes, sir.
Those are the 3 statutory years you need for your computation. So let us look at a thorough illustration. So illustration 1. So are we there on page 15? Are we there? Page 15. Hello?
Yes, sir. Yes, sir. We're there.
Yeah. Standard Trust Bank PSC, a leading financial institution in Nigeria, decided to change its accounting date due to government policy that stipulates that all banks must have uniform accounting dates. The following result was taken from the book of the company. You can see that on that year, the examiner did not give us information about the old accounting date and the name. You are the one to determine it yourself. They don't tell us year ended 31/03/2004, year ended 31/03/2005, year ended 31/03/2006, period to 31/12/2007, 2027. Then year ended 31/12/2028. All our figures. From this figure now, they now told us that required compute the accessible profit for all relevant tax year and give appropriate recommendation. In order to do this question, the first thing you first of all need to do as a student, first of all, determine what the year of change. You determine what the year of change. So looking at, based on the previous analysis we did, who can tell us what is the year of change here?
2027.
Yes, thank you. 2020. Because you can see that the last year ended you have is for which year? 2026. They are yet to, they are yet to prepare any account for 2027. So that means that 2027, since they have a new date, that will be the date that will be what? The year of change. So 2027. Then after determining the year of change, you now what? Identify 2 subsequent years after that year. That will be what? 2027, 2028, and what?
2029.
2020. Those 3 years will be what? Will be identified. When you identify those 3 years successfully, the next thing for you is to what? To also identify the old accounting date and the new accounting date. Who can tell me now what is the old accounting date here? What is the old accounting date?
So it's going to be April 2023 to March 2024.
No, I just need the accounting date. Is what? 31st of March. Have you?
Yes, sir.
The old accounting date is 31st of March. Why the new accounting date is when?
31st December.
The new accounting date is when? 31st December. So after identifying those things, so you can 31st December. So you can now go to your solution. In your solution, you first of all need to carry out your workings. But please, in the exam hall, leave a space for the requirement of the question, because it is not the working that the examiner asks you. You leave a space for the requirement, and what? You now go to the next line to start your working. So starting the working, so you have the working here. So we have Standard Trust Bank PSC, computation accessible profit for, you can see 2027. We have identified that it is 2027, 2028, or another 2 years to 2029 year of assessment. You are going to prepare accessible. What I'm analyzing is on page 16. Page 16, the solution.
Hello, sir.
Under that solution, you have.
Why are they?
Yeah.
I want to ask, please, why are they adding 2029?
Why what?
Why are they adding up 2029?
Okay.
I think it's
when we were look at it. When we were doing it, I told you identify the first tax year and identify what 2 subsequent years. In this scenario, the first tax year they change is what 2027. If you want to identify 2 subsequent years, what will be the 2 subsequent years? Oh yeah, tell me. After 2027, what are the other 2 years?
2028 and 2029.
Yes, perfect.
Okay,
that is why you have those 3 years. So you now prepare accessible profit using what? Both old accounting date and new accounting date. You can see the information there. We have old accounting date. So let us look at the old accounting date firstly. This information is on page 16. Are we there? Old accounting date.
Yes, sir.
You know that the old accounting date is what? 31st of March, Abby?
Yes, sir.
Is that not so? So that means for 2027, the basis period must end as at 31st of March of the preceding year, which will now be 31st March, 3103, 2026. And we now start from where? 1st of April, 2025. Did we get that?
Yes, sir.
Yeah. So it will now be from 1st of April 2025 to what? 31 March 2026, old accounting date. Then this information now, let us go to the information given to us. What do we need? We need up to 31 March 2026. Are we giving that information? So let us go to the.
Yes.
So these are the, after that, yeah. If you look at that information given to us, analysis of profit, we have one for 2023 to 31/3/2024. That is a 12-month period, 800,000. One for 2024 to 31/3/2025, 12 months, 900,000. One for 2025 to 31/3/2026, 12 months, 1 million. That is what we needed. Abby? That is the period we need, 1 million. Is that not so?
Yes, sir.
Yeah, that's why we have what 1 million there under the accessible profit. You can see 1 million under the accessible profit. Then for the next year, 2028, the basis period will be a day after the last one preceding, and which should be what? After March, the next month will be what? 1st of April, 2026 to 31/07/2027. Abby? Yes, if you look at that information, we are not giving that profit directly. The question did not give us that profit. In that situation, that means we will need to what? To calculate, to make adjustment to get that profit. We are going to need adjustment to get that profit. So in doing the adjustments, let us go to page 17. Page 17. Are we on page 17?
Yes.
You will see where they put old accounting dates. Old accounting dates. Go to where you have 2028. What we need is what? 1st of April 2026 to 31 March 2027. And based on information given to us as a for period to 31 December 2027. They gave us information for period to 31 December. According to the question, they give us period to 31/12/2027 to be 1.7 million. If you look at that information, from 1st of April 2026 to December 2027, how many months do we have there? Let us look at it together. April 2026 to December 2026. How many months is that? April to December 2026. How many months?
9 months.
April to December 2026. How many months?
8 months.
9 months. Is it 8 or 9?
9.
April is part of it, oh.
It's 9
It's
months.
9 months. Now April is part of it. 9 months. I mean 9 months. Then plus January to December 2027. January to December, that is how many months?
12 months.
9 plus 12 will give us how many months?
21.
That is why we got this 21 months. So that 1.7 is for how many months? 21 months. That value of 1.7 is for 21 months. And we only need, based on the information we need, we only need how many months? 12 months. Abby?
Yes, sir.
We only need 12 months. We are giving 21 months. So if you now go back to that workings on page 16, you're on page 17, you will see that in 2028, we have a 12 over 21 multiplied by 1.7. That will give us 971,429. That is where that information of 971,429 is being gotten from. I hope it's clear to us.
Yes, sir.
Yeah. Then we now move to the last one, 2029, which will be 1/4/2017 to 31/03/2018. If you look at this information, 1/4/2017, we can get part of it in these 12 months. In these 21 months, sorry. Abby?
Yes.
We can get part of it in these 21 months. How many can we get in 21 months? We can only get 1/4/2026. Yeah, how many months?
9 months.
To December. Yeah, to December. Are you sure it's 9? Yeah, you can only get 9 months from 1/4/20.
Yes. 27.
27
to December.
To where?
31st
to December 2027, which is what? 9 months,
9
Abby?
months. Yes.
Yeah. If we go to page 17 again, you will see. That is why we have 9 over 21.
So we can't hear you again, no.
Sorry, hello? Hello?
Yes, sir. I can hear you.
Yeah, okay, yes. As I was saying, what we needed is a 12-month period. And we have only calculated 9 months. If you remove 9 from 12, how many will be remaining?
3.
3 months. So that means the 3 months we can find it from the next period. And the next period is for what? The next period of 700,000, which is for how many months? 12 months. Abby?
Yes.
That will now give us 3 over 12. If you look at the working, 3 over 12 multiplied by 700,000. If you work out that information, that's the value, you have a value of 903,571. That is where that 903,571 was gotten from. Is it clear to us? That is where that information of 903,571 was gotten from.
Yes, sir. It is clear. Please, but the class ended at 12:30. We're having another class, please.
Okay, is it 12:30 or 1?
12:30.
It's supposed to be. I thought it's 11 to. Okay. Okay. All right. So let me just. Do we quickly round up this or?
Yes, we can.
Yeah. Let me quickly round it up. Then for the new date, look at the new date. For the new date is December. In 2027, that will be 1/1/2026 to 31/12/2026. The next one will be 1/1/2027 to 31/12/2027. And 1/1/2028 to 31/12/2028. Under the new date, for the 1/1/2026 to 31/12/2026. If you look at that information for 2027, we can see 3 months. We can see out of this 1 million, we can see January to March in this 3 months of 1 million. Abi?
Yes, sir.
We can see January to March in that value. So January to March in that value, that's why we have 3/12 multiplied by 1 million. And we need 12 months plus 9/12. This info 9/, yes. Don't forget that 1.7 is what? 21 months. It will now be 9/21 multiplied by what? 1.7. So if you add up this information, it will give you this one, 978,571, which is what? 978,571. Then the next one, we have what? 2028. For 2028, we have a 12-month period, 1/1/2027 to 31/12/2027. Part of this information can be gotten from this 12-month period. 2028, 1/1/2027 to 31/12/2027. We can get it from this 21 months. But we need what? 12 months. If you do 12/21 multiplied by 1.7, we have calculated it previously. That will give us 971,429. That's where we got what? This 971,429. Then for 2029, that'll be 1/1/2028 to 31/12. That information is provided to us straight away by the examiner. On page 16, you see year ended 31/12/2028, and we need 1/1/2028 to 31/12/2028, 700. So you now add up. So after doing this, the next thing, you add up the one for the old accounting date and the one for the old new one. You will see that the old accounting date gave us a figure of 2,875,000. Abi? Why the one for the new accounting date gave us a figure of 2,650,000. So which is the two info. So you now compare. Out of this information, which one is higher? Which one is giving us the higher value?
The old.
Yeah, the old accounting days is giving us the higher value. So you now recommend. Your recommendation will now be what? The computation, the tax authority will have said the tax on what? On the what? Old accounting date. Which is what? Which is 2,875,000 as against what? 2,650,000. Because that old accounting date will give what? A higher accessible profit and tax. And the tax authority is what? Is the one having what? The right of election to elect. So please, then after when you have now selected, so the next thing for you is, I told you to leave a line for your solution. All this information you now have on the old accounting date now, you now write it as your solution for the examiner. All this information are just workings. So you now write this information out because you have selected the old one, the year, the basis period, and asset. So you now write it out. When you are writing it out, you don't need to add it up again. You are only adding it up when you want to compare. You just write it up, write it out as your what? As your solution. So any question? Any question? Any question? Oh yeah, I'm listening. Any question before we go? Hello? Any question?
Oh, no question.
No question.
No question, sir.
Okay. I sent an additional material to the group as well on this. So that question is having an information that is having both cessation, change of accounting date, and commencement. A single question is having the three together. So the question is here and the solution. Please let us go over the question and also look at the solution. So if you have any issue on the solution, so you can as well ask me. So I forwarded it to the WhatsApp group. So we can also, because you should expect, you should also not expect question like what? Single question, like you should also expect question that will be what? Lumped up together by the examiner as well. So please, so it is the network, and I was thinking the timing is 11, and please. So in our subsequent class, so we are going to speed up the timing, and so I thought we'll be able to start with capital allowance today, but in our subsequent class, we start with capital allowance, so you can read ahead for the class. So please, thank you very much, and have a lovely day ahead.
And you too. Please, 10:30.
Yeah.
Thank you.